Hey, happy Monday, everybody. Paul Obrance with This Week in Interest Rates. Wow, that weekend went fast. And here we are on Monday. We're going to talk a little bit about what happened last week, which we received a lot of 30-year fixed rate friendly news. We should have seen a lot more improvement, but we didn't. And then we're going to talk about what to expect this week and a few other things. So what do you say we dive into it? Let's first start with where interest rates are at today. If you're taking a look at 30-year fixed rates, if you have a VA, it's a 6.125. FHA is at a 6.125. Conventional 6.5. Jumbos at 6.375. Keep in mind, these rates are with no points. On conventional and jumbo, we're assuming you put 25% down and a 780 FICO score. Now, this is important to understand. Fannie Mae's national average on a 30-year conventional is about 6.875. So our rates are really strong, but here's why I bring this up. When you look at long-term projections with interest rates, right now, we are no longer seeing any forecasts that will take interest rates into the foreseeable future in the upper or 5% or even in the upper 5%. So the reason I bring that up is a lot of you could be waiting for rates to get lower before you get back into the market. But here's what the other of you are doing. You're out there negotiating deals and getting your closing costs paid for, negotiating the cost of the home. Right now is an exceptional time to buy a house, especially if it's been sitting, to help you save a lot of money. So if you're out there waiting for rates to get in the fives, you may be missing a lot of opportunity. Let's talk a little bit. Oh yeah, that's right. I forgot about the Monday fact. The Monday question that we're going to talk about here is, will paying off my credit cards before applying for a mortgage help? Here's the truth. Everywhere you read, if you chat GPT this, it's going to say absolutely do that. But the truth is, it's incorrect. The best thing that you could do if you want to apply for a mortgage is before moving anything, before paying off debts, before doing anything, is having a strategy session and getting pre-approved. Because here's something you may not know. From a lending perspective, once we get you approved, we pull your credit. And each credit bureau has this system that allows us to tell you exactly what you need to pay off in order to get credit score improvement. And by the way, if you, just as a little asterisk here, if you pay credit card debts off today, this may not even apply for the next 30, 45 days, depending on the cycle of the credit card company. But if you apply and then work with a lender that allows you to do what's called a credit rescore, not only are you going to save money, because you may not need to pay off that credit card to get your credit score up as much as you think, but it's going to allow you to keep money in your pocket. So I disagree with the yes on that. I think you're going to hear yes everywhere you go. If you work with a great lender, let them guide you. And that person would be me. I've only been doing this for 20 years. Let's take a look back at what happened last week. We had on Friday, BLS jobs report came in. It came in much, much lower than expected. And we're going to talk about, news like this is something that would have been very positive for interest rates. And we should have seen much more of a hike. Because remember, when we look at 30-year fixed rates, it's based off inflation. The jobs is something that the Feds is really focusing on. The stronger the job market, the more they need to pay employees. The more they need to pay employees, that increased cost is passed on to you as a consumer, which is inflationary. So a weaker job report is deflationary at its surface. So rates should have improved, but it didn't. And in a second, we're going to talk about why. Another jobs report came out last week. It's called ADP. This is a private sector, like small, medium, and large businesses. Again, we saw a big drop. Not only we saw annual pay increase, but we saw a drop in jobs. And again, this is something that should have been very positive for rates. So now I've brought up two things that should have been positive for rates. What happened? Why did rates go down. Well, if you like Tupac, as he famously says, all eyes on me, but all eyes are on this US Iran deal. When you look at inflationary pressures, let's take oil, for example. By the way, let me come back on the screen. Oil is something that can definitely drive inflation. Increased cost of barrel, it's going to cost more to transport goods, make goods. Those goods are going to go up. You're going to pay more. That's inflationary. Before the US-Iran, we were looking at about $83 a barrel. At its peak, it was somewhere around $126 per barrel. So when we look at short-term, long-term forecasts, any what's the word I'm looking for? Any forecast that has depth and weight is going to mention part of their forecast is going to weigh heavily on what happens with Iran and US. Is the oil going to open? Is the Strait of Hormuz going to open and allow oil to go freely? Or are we going to have blockades and what's going on? So that is something you definitely want to pay attention to. And by the way, good or bad, it could definitely change the momentum of interest rates in either direction. Let's focus on this week. Let's talk about what's going to happen tomorrow. We have ADP Weekly. This is a read on hiring, stronger than expected on jobs. That's going to put an upward pressure on rates. A weak hiring, that's going to be downward pressure. Existing home sales is also coming out tomorrow. This tells us about our housing demand gauge. It's more of a barometer for your business or to see what's going on out there than it is have to do with interest rates. On Wednesday, however, that's when we start seeing the real things that could really impact 30-year fixed rates. We have CPI, which is Consumer Price Index, the headline inflation report, and the week's main event. A hot CPI, guys, this measures inflation, by the way. A hot CPI can really put that upward pressure on rates, but a weaker CPI or inflationary reading could help us and maybe gain back some of those losses that we've gotten back in August. On Wednesday also is a 10-year auction. This is a test of the real appetite for U.S. debt. A weak demand pushes the 10-year treasury and mortgage rates up. Right. So that makes sense. If people don't want to buy the treasuries, that means they need more of a rate of return. That's going to push the 10-year treasury higher, or the treasuries higher. And that's going to put interest rates in a position to increase as well. Thursday, we have PPI, which is a wholesale inflation and early tell for future CPI. If it comes in hot, that's going to put pressure on interest rates. If it cools down, that's something that could definitely help us out. Jobless claims also on Thursday, that talks about, how many, weekly layoffs, rising claims, etc. Friday is retail sales. Here's the deal. If people are out there spending, retail sales tells us a lot about what your mentality is with the future. If we're out there spending, that could be very inflationary as well. All right, last thing we want to end in on, if we're not working together, we should. We do what's called a strategy session. Even if you're thinking of buying a home or you're thinking of refinance and not ready to take an application, one of my favorite sayings is smart people research, brilliant people verify. We've been doing this. When I say we, I'm talking about me and Danielle, for over 20 years. We have 40 years of experience. We've helped thousands of families save money. A strategy session there's no credit pulls, there's no applications, there's nothing. It's just you and I sitting on a Zoom call, going over your questions and giving you solid answers to ensure that when the time is right for you and your family to buy a home or refinance, you're going to save money. That's my goal and my commitment to you. Paul Obrantz, Clear to Close Brokers. I hope you have a fabulous week, and I'll see you next Monday.